Good morning. Welcome to Stock Market Today. It's Wednesday, September 23rd, 2020, and this is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I am at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. Also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities finished higher on Tuesday with the S&P 500 breaking a 4-day losing streak. Growth and momentum extended the strength seen on Monday afternoon to lead the market higher. At the sector level, tech, comm services, and discretionary outperformed, while energy and financials lagged the broader tape. Treasuries are stronger, with the curve flattening. The dollar strengthened on the major crosses, and that's a big development that a lot of people are starting to pay attention to. Gold ended down 20 basis points. WTI crude was up 70 basis points. I guess if you were looking for a narrative, we could say oversold conditions. Biggest reason for the bounce. We did hear from Chairman Powell yesterday in a prepared speech that was largely devoid of any surprises. But what I find interesting is that he reiterated the call for more fiscal stimulus. As we get to the desk this morning, S&P futures are up 50 basis points after Asian markets were mixed overnight. European stocks are rallying, with most of the major markets across the pond up over 1.5%. Treasuries are unchanged to slightly weaker, with a little bit of curve flattening. The dollar is unchanged against the majors. Gold down 90 basis points. WTI crude up 40 basis points to kick us off on a Wednesday morning. That starts with all is right with the world. The Qs retake the $270 mark that we've identified as important. Remember yesterday we started saying look for opportunities, especially in the growth areas of the market. I showed you a growth screen. I still think that that's largely the right move here, given the oversold conditions. For the S&P 500, we extend from 3250, and we now establish that as a key support level as far as I am concerned. You can see it here, right? I mean, look at the right, tested back here in January, tested in June, consolidation in July, and now it's held, right? So let's establish 3250 as an important support level. If we're above that, odds favor a move to the upside. What I'm interested in is what happens when we revisit 3400. Let's take it one step at a time. Obviously, 3400 is another important area. We're waiting on you, IWM. We'd love to see small caps need to get in gear. They don't have to lead, okay? And there's a difference. They don't have to lead, obviously, for the market to work higher. But if small caps get in gear, that's a breath positive for the market. I've said it past couple of days. The more stocks that are moving higher, obviously, that's a sign of a healthier market. So we'd love to see IWM retake 150 and get in gear with the rest of the market and start to attack its highs. But again, one step at a time. That's the framework for the major market ETFs as we kick off the day. Let's hit our market in a minute. What are we writing about today? Well, we extended from the 325 mark, and now that's key support. I think I hit that. Qs retake 270 as growth leads on the day. That's important, especially in light of our shifted view yesterday. Excessive options positioning. Remember, we've been talking about this for what seems like months. It felt like a broken record. Put-call ratio on equity options massively extended in favor of bullish positioning. That has moderated over the past week, really the past couple of weeks. Software is oversold and holding support. Today is going to be a heavy software day. Futures point to a higher open here today. Let's hit the power bars now for the major indices. Dow adds 50 basis points, improved slightly, but still bearish, 5 to 6. S&P 500 up 1%, 108 to 109, bulls to bears there. So let's call that even Steven. NASDAQ up 1.8%, our clear leader on the day, 21 to 15, bulls to bears. 486 to 322 for the smalls, which underperformed, but we're up 77 basis points. Bonds downtick, sending yields slightly higher. Discretionary, big leader yesterday, obviously on the back of strength in Amazon, which had a solid day. 25 to 10, bulls to bears for the consumer discretionary group. Remember, consumer discretionary has been a relative outperformer, strong relative trend, even with Amazon fading over the past few weeks. So that's an encouraging sign. According to the Chaikin Power Bar, small cap stocks are somewhat more bullish than large cap stocks. Major indexes across the board are mixed. Let's hit our stock of the day. Speaking of software, Adobe, ADBE is your ticker symbol there. Closed at 486.78 yesterday, up 2.3%. For this stock with a bullish rating, strong trend, strong industry group, with a setup that I like. What we're seeing here is we have a bullish stock. It's outperforming. And what's interesting is the intensity of outperformance beginning to pick up again, right? Here's your growth stocks beginning to lag, right? Never underperformed, but lagging, right? Weakening relative strength. And now that's beginning to reassert. Very similar to what we talked about with semiconductors yesterday. At the same time, our overbought, oversold indicator is moving higher in an oversold position, while Chaikin money flow is solidly bullish. Taking a look at the price action here, what I see is a breakout pullback to retest the breakout level that held at our rising long-term trend line, and is also triggered one of our buy signals today, this one being the relative strength buy signal. So Adobe looks like a compelling name to me on the long side here for a reassertion of that growth over value theme that we started to talk about on Friday, followed up with yesterday. So connecting those dots, looking for other pockets of opportunity. I come to the software group and I look at a name like Adobe. Remember, go back to yesterday's show and the screen that I provided of growth stocks, right? So those are to me where you're looking for opportunities right now. So Adobe sets up, it's in my note and here for you to think about today. Let's look at our sector tracker now. Movement over the last 5 days for the major sectors. Tech at the top of the list. Everything lower, but tech at the top of the list is an encouraging sign. Industrials, one of our favored cyclical groups. But I will say we're watching this dollar strength closely, because if the dollar continues to move higher, that's going to put pressure on our inflation theme, and that's going to put pressure on the cyclical areas of the market, in particular materials, which we can see are at the bottom of the list, just above real estate, which is nothing short of a disaster. Staples in the number 3 slot, followed by discretionary. Energy, healthcare, comms, middle of the road. Utes, fins, materials, and REITs at the bottom of the list. Utilities at the bottom of the list is not a bad thing, right? Utility underperformance is generally a positive for equity bulls. So we like to see that there. Financials, you've heard me talk about those ad nauseum. Same with the energy complex. So I'm not going to rehash that view here. It's ugly and just don't see any signs of life just yet. Our industry in focus, as I said, today's going to be a heavy software day. Remember, this is auto-generated, and then I put it together for you. In my note, I highlight a different software ETF, IGV, which we'll look at a little bit later on in the show. But software and services, this one's a little bit broader, which over the past 6 months, it's been a leader, right? Outperforming the S&P 500 by 18.35%. Power bar ratio, which looks at future potential, is strong, 42 to 26, bulls to bears, currently ranked number 8 of 21 subsectors, and it's moved up 4 slots over the past week. So some names there: Conduent, CNDT, Sykes, more on the services side, and EBIX, all with very bullish ratings. So you want to drill down, see what the relative strength looks like, see if it's an opportunity. But I do think you want to be focused on the software area for potential opportunities, and especially with names like Sykes, right? Don't just go to the go-tos, right? If I look at a name like Microsoft, it's beginning to underperform the market. Now, I like Adobe. We've talked about it. But you can start to look at a name like SYKE here with a very bullish rating, strong trend, strong industry group. Here in the near term, what I see is the potential for personality change again. Now, we did get a head fake back in August, but reasserting to the upside on a relative basis, closer to overbought than to oversold with some bearish money flow. But this is definitely a name that I would have on our radar screen. It triggered our relative strength buy signal again. So we saw the relative strength pick up in Adobe as well. So obviously there appears to be a theme playing out here. Not as clean a chart, but definitely an interesting name, especially if it kind of holds above this $28 to $30 level. A few ways to play it. Given the overbought condition, you can look for sideways action that works off that close to overbought condition. At the same time, I think a breakout through the 34-ish area right up here starts to look compelling. So, just some different ways to think about it. It's not just Microsoft and Adobe in the software space. There's some other opportunities there when they set up properly. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers. Twitter. Internet names were strong yesterday. I didn't see anything company specific on Twitter, but do note that they did catch an upgrade last night. Amazon was upgraded yesterday morning, and Sanford Bernstein sent that stock higher by 5.69%. And obviously that helped that consumer discretionary group lead on the day. Ralph Lauren, some more talk about their reorganization plans. AIV, a couple of moving parts here. Number one, they are potentially splitting the company. At the same time, there is an activist investor involved. That stock higher by 4.9%. DR Horton, the builders, starting to reassert again as well. DHI up 4.7%, a very bullish stock, one that I think is extremely compelling, along with Lennar, LEN. On the loser side of the board, banks are ugly and potentially getting uglier. CFG down 5%, Zion's down 4%, CMA down nearly 4%. Nothing company specific on these names, just pressure on these bank stocks. Anthem, ANTM, and HCA, part of the healthcare services group, that was under pressure yesterday. Both of those stocks down nearly 4%. So we talked about healthcare a little bit in our note yesterday, and just the relative trends in healthcare don't look great for the time being. So just something to keep in mind as you're looking at names. But healthcare is a broad group, so you do need to do some extra work there. Let's talk about sentiment, as we always do on Wednesdays. The CBOE equity options put call ratio. The bullish position moderates. I mean, for the longest time, we were talking about the excessive bullishness, the excessive greed that we were picking up in this indicator. Again, this is the 13-day moving average of the equity put call ratio. And with the market selling off a bit over the past few weeks, it has moderated. Now still below the 0.6 area that, marks excess greed, but, certainly much less intense than what we'd seen over the past couple of months. It's actually, to me, an encouraging sign for equity bulls. At the same time, the VIX has pulled back underneath the kind of 35, 40 area, but still somewhat elevated. There's no two ways about it. A VIX above 25, 26 can present a tough environment, which is why we said start to deploy cash. It's not a binary call. I'm all in, I'm all out, right? We start to look for opportunities while recognizing that we are still in a elevated volatility environment. So just something to keep in mind there, but definitely moving in the right direction on the put call ratio for equity bulls. So just that's one of the things that's on our radar screen here today. As we take a look now, I said we would talk about software. So XSW is software and services. IGV here is more pure software. And what I see here is a breakout, a pullback, right? Very similar to the Adobe chart, if you will. Breakout, pull back to retest the breakout level, a little zone of support here between 280 and 300. From which we can start to think about moving higher. And that's what we've done over the past couple of days, begun to move higher. At the same time, IGV is above the rising 200-day moving average. So from a longer-term trend perspective, the trend is still intact, right? So we had the short-term hiccup up here as the growth trade came off, consolidation at the support zone and beginning to move higher. So we want to see this continue to play out. Now, why do we think it's likely to continue to play out? Well, because the RSI is holding bullish ranges. Check out that middle of the chart there inside the blue box. You can see the RSI holding above 40. So during the sell-off, never reached an oversold condition and is now beginning to move higher from the lower bound of bullish ranges for this indicator, while at the same time, the uptrend on a relative basis, IGV relative to SPY, remains intact. So we'd love to see relative break to a new high. We'd love to see IGV continuing to move higher as part of the process of beginning to redeploy capital that may have built up as part of a strict risk management process. And finally, let's look at the dollar. I think this one's important. It's important for a lot of reasons. Number one, there's tended to be an inverse correlation of late between the dollar and risk assets, right? So that's number one. Again, go back to the VIX at 26, and that's why you're not throwing all your cash into the market all at the same time. What we have here is dollar weakness moderated through August and much of September, and is now appears to be resolving from the upside. Now, there is a ton, and I mean a ton, of overhead resistance starting at the 95 area for the dollar index. What's interesting to me is we had a bullish divergence leading up to this breakout. So what does that mean? Well, we've been talking about the inflation trade. We've been talking about it since the end of June. That's largely been the right call. But now, if the dollar continues to strengthen, that view, right, has to come under review. You can see commodities maybe beginning to roll over a bit as the dollar has strengthened. So just something to keep in mind, especially in light of our view on materials. That'll wrap us for today. Take us for a test drive. I'm back with you tomorrow.